Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, March 28th, 2017. It is exactly 3:13 p.m. Eastern Time, so a little more than 45 minutes left in the trading session. I stepped away from my desk for a little bit, came back, didn't expect much today, but a little surprised on the strength of the rally. But not in any way shocked, but I figured it's time to do a video update. A couple things worth highlighting. First and foremost, we'll start out here on the SPY. I'll spend most of my time just looking at the 30-minute charts. I might jump out to the 60-minute if there's some trend lines and things that go back, and that's what I'll do here. So here's a 60-minute chart. Actually, we need to go all the way to a 2-hour to get that trend line. I just wanted to point out this trend line in the SPY. A little concerning to see that regained. I've put a lot of emphasis on this trend line recently. We broke down below it the other day. We back tested today, but have since punched up through there. A little bit concerning. I did a video the other day, you guys might recall, and I talked about how the market, all U.S. indices except the NASDAQ and the NASDAQ 100, which is just a subset of the sub-index of the NASDAQ composite. So the NASDAQ is the only U.S. index that didn't top back on March 1st and is not still in a downtrend. And I also, I talked about what a downtrend was. Let's just draw it out here. A downtrend is simply a stock or a security making a series of lower highs and lower lows, and I pointed out this reaction high the other day, a small reaction high. Now that's been taken out. So I said, what you want to see if you're bullish or if you're bearish but short, or if you're bullish and long and you're looking for evidence that the bounce is over, you want to see evidence, proof that the downtrend is called into question. So here's your series of lower lows down here. Here's your series of lower highs. This high's been taken out, so that certainly is, that's one of the reasons I wanted to do the video, and the fact that we've taken out this uptrend line. So any way you want to spin it, this is something to be concerned about. However, it's far from eliminated the downtrend. You don't have to have every single reaction taken out. In fact, you can draw a downtrend line. Let's see, I've done that here. A potential downtrend line. Here was your first reaction high, second reaction high. Maybe this serves to ultimately be the downtrend, and these are your, you'll have a major reaction here, major reaction here, major reaction here. And I talked about that in the video, that taking any single previous reaction high out in no way, shape, or form completely eliminates the fact that we're in a downtrend, because in the most simplistic view, we're still making, we haven't taken out the previous reaction highs up here. We haven't taken out this one. We just took out one minor small reaction high that came actually pretty close really to the previous one. But again, I wanted to point that out. Now, somebody in the trading room just the other day inquired about some divergences that were in place. They inquired on the 4-hour chart. When we looked at the 4-hour chart, which I just flipped to here, it wasn't really concerning to me. I could see a little on the RSI there. Now, those divergences did show through, and I should have really focused more so on the 60-minute chart, and I've drawn them out here, or on this 30-minute chart that we're looking at. So you can see bullish divergence. And my response as to why I wasn't too concerned is, if my analysis is right, which I still, at this point, let me make it clear, I still believe it is. I still believe there's more downside to come. Then the scope of these longer term divergences, I'm jumping back out again now to a 2-hour period chart. You can see a series of divergent highs culminating in this 4th consecutive divergent high with very large, powerful negative divergences, and even more so, more importantly, and again, this is what I stated, negative divergence on the daily time frames as well as these breakdowns. And that's been my experience that, well, I can just tell you, and this is TA 101, the longer term time frames are much more significant than the shorter term time frames. And if this is indicating is we've had sell signals across the board for the first time in many, many months on the daily time frames. 60-minute, 15-minute, that's a whole different story. Those are good for quick trades. But we've had breakdowns and confirmed negative divergence on the daily time frames, which in my book is precedence and says that we may be in the start of a much bigger correction. If that's the case, where I'm going with this is it's very common to see bullish divergences like this, and this is what we'll look at. And this is really the cause of this rally. It seems at least preceded the rally. So it's hard to argue that it played into it. This 30-minute divergence here shows on the 60-minute as well, is that if the primary new trend right now, at least I won't call it the primary, the near-term trend or intermediate-term trend, in other words, we're going lower, let's assume for the next, hard to say in days, weeks, but another 3, 4, 5% or more downside on the broad markets, then what will happen is this bullish divergence here will play out less than expected. Normally in a strong uptrend, you might have a much more powerful rally, and that very well may prove to be the case, guys. But until we get up there and we start taking out, especially these other higher reaction highs, and of course that'll put us close to the, back to the new highs, and it's not that far away. Here's the thing: if you're short and you short it up here, then you're only talking about another 1.5% until that reaction high is taken out. So there it is on the SPY. That is most likely the catalyst for this rally. Again, went a little higher than I thought, and it's given me pause. I've mentioned adding, short exposure over the last week or so, but I won't add now until this fails. This little pop above that recent reaction high needs to fail, and I'd like to see it fail today, meaning a sell into the close, and this then proved to be one of those, one more in a very long line of whether it's the big boys on Wall Street, the powers that be that can ramp the market, blow out some shorts. I'll tell you what, if I was Goldman Sachs and I had tons of capital, billions of dollars of capital, and the ability to see where all the market orders are standing, like these big trading desks do. I'm sorry, the stop loss orders, the limit orders. And, just knowing that's technical analysis, there's a pretty well defined there's a gap back there, reaction. That's all you have to do is just pop it above that level, and you've just run a good deal of the stops on short trades, and then the market can fall down. So that's what I would like to see, and I'd be quite content. I won't add again today, regardless of what the market does. I want to see now this low taken out, and I'm more concerned at this point if the market starts moving up, takes out. That's just a minor reaction high. This is a big reaction high, and again, I'm not even short the SPY, but I'm just telling you what would really hamper the bearish case and certainly open the door to move to new highs, and that would be for that level to be taken out. But as of now, just keep it very simple. Here, let's look at Fibs too. Something else I should have mentioned. I showed some Fib clusters the other day, but here's the move, the March 1st high. Remember, all of the indexes except the NASDAQ peaked on March 1st and have been in a downtrend since. In a downtrend, again, forget about the reactions. Just look at where prices are going. This is a downtrend. This is an uptrend. And these are near term. The primary trend, long-term trend is still bullish. There's no arguing that. But near term, we're still in a downtrend right now. That's starting to be called into jeopardy, but by no means eliminated yet. And then when you look at these Fibonacci retracements off that March 1st high, we're right at, you can see we just hit that, or just shy of that 50%, which is still within a typical counter trend bounce of a move down. So if this is a new downtrend, this is just a typical counter trend rally, and nothing really at this point to be concerned about. And that 30/60 minute divergence may very well have played out for its move. But again, you guys now know what I'm watching for. I don't want to see this continue much more, or then I turn from, a mindset of where to add any more short exposure versus where to start subtracting short exposure. As always, my individual positions, the individual short trades on the site, they have their own specific stop criteria, and that I stick with because the market doesn't have to play out other than the QQQ active short. The individual stocks, both long and shorts, they're going to do their own thing based on their own chart patterns. But I'm referring to the any broad market shorts. I made it clear I'm short two indices, the small caps and the NASDAQ 100. The small caps, it's not an official short trade idea. It's just something that I'm trading on the side. This is QQQ 30-minute chart, shows you the same thing, bullish divergence again that I had underestimated that playing out, and it's certainly played out for a decent move. And the Qs, now the Qs, are really no longer in a downtrend. It started to have the early makings of a downtrend here. You know, if you look, we peaked right here, as I mentioned, the NASDAQ 100, which is just a subset, the 100 largest stocks within the NASDAQ composite. It started to have all the makings of a downtrend, very early stages, a high, reaction high, a lower high, a reaction low, a lower low, but now that's been taken out. And just without doubt, what I can say is the NASDAQ 100 is in a sideways trading range. It's not in an uptrend, at least near term. Again, not talking longer term. We know there's a primary bull market right now that is far from being in jeopardy at this point in time. However, this going all the way back here to, what is that? It's about over a month now, is a sideways trading range. So neither bull nor bears can declare victory on the NASDAQ 100 because it has clearly gone nowhere but sideways, and that's where that is. So we'll just not spend too much more time on that one. Covered the SPY. Let's go down the line now in market capitalization size. This is a mid-cap MDY, the mid-cap ETF, tracks the mid-cap index. And you can see we're right at about, we're just, if I circle that, we're failing, just popped a slight hair above these two previous reaction highs and starting to turn down. If we go much more, we've taken those out. But now look at this downtrend line you can draw. And this is what I'm talking about, that you don't have to take, you know, literally, and I made that clear the other day when I talked about the downtrend, that we can take out any one previous reaction high, but it's as you start taking them more out, you're just building up evidence that they're chipping away at the evidence on the bearish case. So you have so far, in fact, this downtrend line is pretty well defined in the mid caps. You have the high on March 1st, as I said, that every other index besides the NASDAQ top. Then you have quite a few reactions there. So there's a fairly well-defined downtrend now in place, and it would even be more significant and further validated, that trend line would be, if we popped up a little bit more and touched it and then turned down. So then you could see, you could almost draw a descending price channel here. And those two lines are parallel, and so that's a likely path that the MDY could take down. Just as we were, if you look over here, and I'll go back out to a 60-minute chart, we were in an ascending price channel, and here it is. So now we're in a descending price channel at this point in time. So until the top of that, this is where I would really start to worry about or call the near-term downtrend in the MDY into question. Not so much the fact we've just popped above those recent highs from just a couple days ago. And then this one, can't say we put the nail in the coffin. The real nail in the coffin is technically when you've taken out the new highs. But to see this high, this reaction high over here from about a week or so ago, that would certainly really call the downtrend into question on MDY. So let's just look at Fibs real quick, and here we are. Fibs again off the highs, March 1st highs. You're seeing it on a 60-minute chart here. I think I have it on a 30-minute. Nope, I didn't. Either way, look at that. Stopped cold at the 38.2, which is a minimum typical retracement. I mean, when I have a counter trend rally, I typically see counter trend rallies fail. Not always, but typically anywhere between the 38.2 to the 61.8 fib. And so if we do reverse here on the mid caps, that would be just a minimum counter trend or run-of-the-mill counter trend bounce within a more powerful uptrend. So again, really nothing to worry about in bigger picture at this point in time, but certainly something to monitor. Okay, here's the small caps. This is where, you know, I have, as far as index shorts go, my largest position's been for weeks now. Still looks fine, but obviously we can see the bullish divergences have played out. We're looking at a 30-minute time frame here, so you can see across the board on all my indicators and oscillators below. I have a 2666 EMA pair histogram there, the RSI. And you can, if you exclude that little brief spike, you have quite a few reactions there. So this makes up what looks like a bullish falling wedge. And look where we stopped so far. I happen to have the fibs up here. I'm assuming, I'll have to verify, guys. I'm not sure where those fibs are set. Let's go out to a 60-minute chart. I'm going to have to get rid of those fibs. I'm going to look at a cleaner board here. March 1st, there we go. Get rid of this one. Should have cleaned this up for you. There it is. Okay, here's the March 1st highs, which were the highs, you know, for the most part, all-time highs in most U.S. indices. And here's the retracement so far. I tightened that line up. Look where we're at. We're so far, we're printing the second candle right on that minimum 38.2% Fibonacci retracement. And clearly the small caps, despite this rally, which again, I underestimated based on those divergences. I didn't think they'd play out so far. The trend is down in the small caps and will remain down. And if and when we take out these reaction highs up here, that would certainly call it into question. We'll be above what could be a potential downtrend line. There's only 1, 2, 3 reactions so far on there. Let's look at this on a 30-minute chart again. So there it is. Yeah, there's that 38.2% fib wedge pattern, and still quite a bit of resistance overhead. There's some other Fibonacci retracement levels that also line up nicely, like this 50% fib lines up nicely with horizontal support. You can see right here. What am I looking at? Just to clarify, I look at these reactions. I see a reaction right there, right next to where it says 50%. There's a candlestick. There's a reaction, quite a few reactions from above, quite a few reactions from above. It broke. Reactions from below, a reaction tested from below. Remember, support, once broken, becomes resistance. We reacted, broke above it, and then gave up the ghost and saw impulsive selling once we broke below it. So again, what I'm saying is this: I really like to see when Fibonacci retracement levels also line up well with the horizontal price resistance, or sometimes trendline resistance, and that's the case here. So although I would much prefer to keep the bearish case well and alive and intact, see us turn down and take out the lows in the next day or two here, I'm certainly open to the possibility of a push up here to just shy of the 137 level, 50% fib retracement off the March 1st highs, horizontal price resistance, and then seeing prices go down. All right. I'll wrap up here with the IWM daily chart. Busy chart here, but the story, let's just go back. This goes back 2 years, shows all the divergent highs and just how powerful those corrections. And I also showed all the divergent lows. And this is where I'll get excited. If we start to see a divergent low on the daily chart, I can almost assure you that's where I'll be looking to cover if and when we get those. And we might not, but if we do, which I think at some point in the coming months we will, that's a good place to reverse for a swing trade on the long side. But as of now, the most recent story is this, or I should say the story is this most recent divergent high. Trend line, uptrend line was broken down. We had very strong and clear, powerful negative divergences at that high. We broke down, and as I pointed out recently, the IWM, for the most part, has been in a trading range since early December, and you can see this. Nice, well-defined sideways trading range here. I might have clipped it a little high there, but I think you can make that out. So that's the story on IWM. We're in this trading range. It looked like we had a breakdown below, but there was a stick save. Stick save, you see how we traded below, but the candle's green, meaning we'll close back above there. So we've yet to give up, as I've been highlighting recently, this 133.45 level. This was a very critical level. And you can give the bulls credit. They defended it so far, and they had a little fake down and move back above it. And so I suspect there's a good deal of short covering. I have you probably can't make them out in the video. I have a series of moving averages. I have the 50-day EMA, 20-day EMA, 200-day EMA, and they're all pinching above. Again, you'd have to tune it up. You can put those. I have all three of them pinching together here. We've probably made some recent depth crosses, which are when a faster moving average moves above a slower moving average, but those are also likely to come in as resistance. So I still think that this level is going to go, and I still think it'll happen soon. Trend indicator, the PPO is trading below the zero line. everything else that I have. Oh, and that's something else I wanted to talk about real quick, and then we'll wrap up. I use these 60-minute trend indicators, as you guys know, the two of them being either the PPO or the MACD signal line. I talked about that a little bit in today's earlier video on gold, and I use the 9 EMA, and which is the last of the two to cross, whether it's above or below. It's still well below. It gave us triggered a bearish sell signal or trend indicator there to have flipped or crossed down below the 0 line, still well below the 0 line, and this is on the SPY, the S&P 500. And I also use this 1333 EMA histogram that's just showing a visual representation of when the 13 EMA is trading above or below the 33. And in this case, we have the 13 EMA still below, and that still keeps the trend on bearish as this point in time. Any more upside, you can see that we're right on the 0 line right now. That's where the reading is. So depends on how the next couple 60-minute candles close. We could have a cross back over on the SPY, but as of now, the trend is bearish, just as it was bullish throughout this whole period. And it gave us our first bearish signal here, and we just had a whipsaw to the upside. So really, it's for the most part, it's been bearish all this time, just as it was bullish this whole time. And you know, it's done a good job of telling us right now the trend is bearish, and nothing's perfect. But you can see also the PPO cross down below that level, little whipsaw signal there along. They tend to move together, those two trend indicators. But small caps, let's see what they're at. Yep, still right there, really close. So it depends how these 60-minute candles close. The PPO is still trading below the signal line. So like I said, we're at a pretty important technical juncture. And again, it would really help the bearish case to see things turn down here. And if we manage to hold up or ramp a little more into the close, then I would really, really want to see a gap down tomorrow and a big red day. Otherwise, you know, every tick that we go up from here at this point starts to chip away at the bearish case. Doesn't eliminate it yet, but calls it into question. But as of now, I'll make it very clear, I don't see anything in the chart concerning me right now with my short positions, and I still think we're going to see that. We're going to see the markets turn back down here soon. Hopefully this helps, and right or wrong, do your own thing. Use stops that are in line with your own risk tolerance and dependent on your own positions. And if you guys have any questions, just reach out to me, drop me a line in the trading room, and I'll get back to you as soon as possible. This has been Randy Finney with Right Side of the Chart.